My goal here is to help you understand what I really think is the most essential part of understanding business, and that's understanding how to value things. If you understand valuation, all the other business stuff that comes around it ends up seeming so much easier because you really, it's like you now know the internal secrets that the business people are always trying to get at. And once you know that, the rest of understanding business becomes a lot easier. Once you understand business, your ability to be a lawyer representing businesses becomes that much easier. And really, just your job as a lawyer becomes that much easier. So what I'm planning on doing is over, like I said, either every Tuesday or every other Tuesday, start walking you through how to do valuation, okay? Now, I just wanted to, I wanted to give a quick, I have a little, oh, I even have a little laser pointer here. I just want to, I think, yeah, there we go. So, and I assume most of you know that, Bill Murphy and I wrote a book on patent valuation. But I don't know if everybody knows as well, Professor Ritchie and Gordon Smith. Gordon Smith is a former trustee of the law school, and he also teaches an IP valuation course in the summer. And then Susan Ritchie, who I'm sure you all know, just recently published a book on trademark valuation that came out in November. So a fair amount of valuation expertise. Kind of odd that all this valuation expertise ended up in a law school in New Hampshire. Anyway. So, anytime you talk about valuation, I think this is mandatory. This is the basic slide you would get if you were doing an MBA at just about any business school in the country. You always start, anytime you're talking about valuation, the basic concept, you can't manage what you don't measure. Now, what does that really mean? For people who don't know much about valuation, I find that almost the first thing you need to do is break down a bunch of preconceptions. The first preconception is that valuation is about putting a dollar amount, some sort of very important dollar amount on a good or service. That's part of it. What we're going to be looking at over the next few weeks is not about doing appraisals. It's not about the idea that I need to fix some value that is some sort of an intrinsic value that really is always, this item is worth X, and that's always the case. That's really not going to be the function of what we're going to try to do over the next few weeks. What we're going to try to do over the next weeks is really understand how to make better decisions in life. Every decision you ever make in life is a value proposition. You are always, whenever you make a decision, you are choosing one thing over another. And whether you realize it or not, what you are trying to do is always make the choice that is the most valuable one to you. Now, I'm going to go through a couple of examples. I don't know whether I'll go through all of them. I got a lot of examples here, just to sort of really help you understand that when we talk about valuation, valuation is something that is in everything you do. Now, this is a choice that I care a lot about because I always find I stop whenever I'm buying. I go grocery shopping. I bump into a fair number of you at the grocery store quite often. And where I always stop, this is the one that always just causes me to pause, is when I'm buying yogurt. Now, as you probably know, I'm incredibly cheap. So, when I get to the yogurt stand, I always have to make the choice, right? Do I buy the brand name yogurt? And I think this is probably about right. I think it's about $1. Actually, it's probably more than that. It's probably about $1.30 for the brand name yogurt. Or do I buy the generic yogurt, right? For 60 cents per cup. And I get, you get stuck there. Now me, I'm cheap. I always buy the cheaper one. Now what am I really doing there? Well, I'm actually making a valuation decision. Let me just sort of, let's put some numbers here so you kind of illustrate how you would be making this type of calculation. Let's assume here for the brand name yogurt. The brand name yogurt, and I think we would all agree, the brand name yogurt tastes better than the generic yogurt, right? Now, let's assume that for the brand name yogurt, you ascribe a value to that yogurt of $1.10 per cup. Now, without looking at choice B, so I got my yogurt, the cost is $1 per cup, you ascribe a value to it of $1.10. Should you buy the yogurt? You should buy the yogurt, right? By buying that yogurt, you have now created 10 cents of value, right? You've given up $1, and in exchange, you've received $1.10 back in value. Easy decision. Now, and here's where my cheapness comes in. The generic yogurt, it is not as good as the brand name yogurt. You ascribe a value to it of 90 cents. Which should you buy? The brand name yogurt or the generic yogurt? Generic yogurt, because if I buy the generic yogurt, I receive 30 cents of value for each one as opposed to 10 cents if I buy the brand name. Now, these are the types of decisions you make all the time. Every time you go grocery shopping, everything you put in your grocery cart is a decision. Now, you're really making these calculations in your head. You probably don't even realize you're doing it. It just sort of becomes, well, I like this one better than that one. But you are looking at price. So, it might be, I like Fruit Loops better than Fruity Pebbles. Well, the Fruity Pebbles are on sale today. They're half price. Okay, today I'm going to buy the Fruity Pebbles, right? Those are the kind of choices you're always a valuation decision. Now, in many ways, it's kind of a silly example, but it's really the better you are at doing that, the more value you create. Now, when you're thinking about your own personal shopping habits, you're probably not generating a huge amount of value one way or another. If you're representing a client that's doing millions of dollars worth of business, or billions of dollars worth of business, or tens of billions of dollars worth of business, if you can improve their valuation thinking so that you improve their decisions by 0.1%, well, 0.1% of $10 billion. And one of the secrets you'll see is I'm not really very good at math. 0.1% of $10 billion, I can tell you off the top of my head, it's a lot of money. Now, just a couple other ones here. Just sort of like, let's start with like some personal decisions, right? And all of you were confronted with this type of choice, right? You decided what type of graduate degree were you going to get, right? You're going to get a JD, and I just threw up some costs here, or I don't know how accurate any of them are. Do you want to get an MBA? Or do you want to get a master in philosophy? All very different prices, right? The price alone is not going to help you make, well, the price is going to help you in your decision making, but the idea then would be you should have ascribed some type of value to each one of these decisions, and then you should have picked the one that was most maximizing to you. Now, one other thing that I just want to make sure we appreciate when you're making these types of calculations, and remember, we're going to be doing this over 6 weeks, and as we get into it, we'll start really digging in to how you value things, not just what you might think of as sort of the cash flow that's coming off of it, but also things that you might say, well, I have a personal value there. We can value that as well. Now, as you'd be doing this, one thing that you could be valuing, and honestly, it just surprises me, one, that more students don't do this, and two, that there's not a service out there that makes it really easy for you. What are the expected earnings you're going to get from each one of these 3 jobs? Right? When we start figuring out what's the value here, what is the value of a JD degree? What would go into it? So you have the right to work a job that someone without a JD does not have, right? So you can so first part of our proposition, it gives you an opportunity to work a job that the vast majority of the population is excluded from working in. You could then take those jobs and think about, how much money do I expect to make from that job for the rest of my life, right? That'd be one part of the valuation you do. And I'm surprised there's not like a little easy software program that allows you to do that. You should be able to do that. What other value would you get there?
Personal level of enthusiasm for the degree.
Personal level of enthusiasm, right? So like, let's say, and I for those of you who took contracts with me, remember we went through the case file and we're looking at the concept of specific performance, and we were looking at teachers, and we had a couple of cases where teachers were fired from their jobs, and what the court said was the value of their contracts, the value of their jobs was their salary. I said, well, that seems kind of wrong to me, because it seems, I work kind of on a teacher's salary, not totally a teacher's salary, but close enough, that you realize you don't do this job simply because of the paycheck. So you might want to start figuring out what's your personal enjoyment that you would get from that type of job. So it might be you like the law, it's fun, it's interesting. It might be, you know what you really like to do? You like to sit around and talk about philosophy. I don't know anything about what you get, what kind of job you get with a master in philosophy. My guess is not a very well-paying one, right? But if you get to spend your life, talking about philosophy, that might be really very interesting to you. That may have more value to you than a high paycheck, right? And you'd be going through, but what you could do is start to break down for yourself what this value is and whether this value greatly exceeds this cost of $100,000. You could do this for each of them, and in the end, you should be able to make a very thoughtful decision. Now, as we kind of go through this, when I put this example up, one of the things that I'm going to try to show you is that you've got to make so many valuation decisions that oftentimes what you need to learn how to do is you need to learn, I don't really want to call them tricks, because they actually are valid valuation techniques, but you need to learn how to do valuation techniques that allow you to very quickly make your valuation determination. You don't usually spend a lot of time, where you'd go and say, I'm going to spend weeks on this, really trying to come up with a good valuation with lots of Excel spreadsheets and a real thorough valuation. But then there are issues like this. This is one of the most important decisions you will ever make in your life. Did anybody even come close to doing any type of analysis of what your choices were, what the cost benefit? I mean, even just a quick and dirty cost benefit analysis.
Yeah, I looked at the average salary versus what my current salary was, versus my potential to move up the corporate ladder, and said, screw this, I'm going to go get a JD.
I mean, already that's good. That is a good start. Did you look at other options, though?
Well, because I was already working in business, I didn't really consider getting an MBA, because the people who I saw having an MBA versus the people who had experience in business, it didn't seem like a very good trade-off. It's better to just work.
Okay, that's good. I would say when I asked the question, I'd say the vast majority of it, I could see you kind of nodding, going I didn't. How did I decide to go to law school? My roommate was taking the LSAT. So I took the LSAT. I went to law school, right? That was basically my decision-making process. You can make better decisions, though, with really just a little bit of work. Okay. Now, wait, did I skip forward? Okay, now, pretty soon you're going to have to make a choice about where you're going to work. Again, you can do a valuation analysis when making the choice. A lot of people will come in and talk to me, when you're starting, let's say you potentially have 2 offers for jobs. You say, how do I choose between which job I should take? You can do a valuation analysis. And frankly, by the time we're done with this sort of seminar, you should be pretty comfortable doing that type of analysis in a way that you will be able to make a much more confident choice. And it really won't feel so much like, I don't even know how to start going about this. You should be able to start to flesh out this type of issue so that you can come up with a thoughtful answer. All right, now, sort of getting to the idea of, well, we're talking about this in law school. It's amazing how often valuation should come into your decision-making process as a lawyer. So here, I've just put up, I'm going to flash up a couple of quick examples of legal strategies where you would be counseling your client. So this one is, your client has a competitor and they want to compete with the competitor. Now, there are actually a lot of choices they could go through, but I just sort of broke this down into really sort of 3 broad categories of choices. I can make a superior product. I can compete head-to-head with my client and just be better. I never liked that choice. That's hard work. Right? Choice 2. I can acquire my competitor or merge with them. Right? One of the easiest ways to get rid of a competitor is join them. Finally, and since we're at an IP school, one of the choices you may have, well, I may want to try to sue them for patent infringement. And as a result, disrupt their ability to manufacture the good that's competing against my good. Right? All different choices. I can go and look at and do a valuation analysis for my client to help them make this type of decision. Now, you'll see, this decision, and one of the things is, as you start to think about this, right, you may go, well, this seems like there's a lot of business involved here, right? I'm not a business person, I'm a lawyer. Why would I be doing this type of valuation analysis? Here's the problem. You ask a business person to do this, and you know what a business person would say if they saw this very same chart? They'd go, well, there's a lot of law involved. Suing for patent infringement? I don't know, right? Acquisition and mergers, there's a lot of law that gets involved there. I'm not quite sure. So I ask a business person to do it, they go, well, I can't do it. The reality is, in order to be able to make this decision and make the best decision, I need to understand both law and business in order to do that. One of the things we will as well look at during this seminar is how you can combine expertise. You don't have to have all the expertise. In fact, that's really one of the big secrets, is to learn how to operate in an area where you really don't have the expertise, but you're comfortable. Like, that's okay. You know what? I don't know anything about your business. I don't know really anything at all about your ability to make a superior product. But you know what? I know how to tease that information out of you. I know how to work with someone who has that information so that collectively we can make a much smarter decision. This is just an example from my securities regulation class about what we're covering right now. And it might be the idea, I've got a startup and we want to go out and raise capital. All kinds of different options that I could use. In making that decision, I should be doing a valuation analysis as I do that. Lawyers almost never do it. You just go, here's the option, there you go, move on. And one of the reasons why I'm just such a huge advocate of this, the law, actually, let's go back to here, right? You're competing with a competitor. You're a lawyer out working for a law firm. And in law school, it always feels like the law, it's almost like, I always felt when I was in law school, it's like you're a priest, right? You've got doctrine or dogma, and then you go and preach it, and you go and you look for justice, and it's really that simple. That's not really how it works in practice. In practice, you're a business person providing a legal service, competing against other business persons providing a legal service. It's a competitive environment. One of the things I really learned once you start practicing, I want to have a lot of clients. How do I get clients? Well, I need to be better than my competitors. One way you can differentiate yourself from your competitors is learn how to talk to your clients in their language as opposed to your language. Lawyers are terrible about that, right? We talk in our language. We think our language is superior to everyone else's language. And we talk to everyone as lawyers. Well, we can listen to each other. Business people don't like listening to us. When I want to start showing them what this choice is, and I can show them this is a value proposition, you know what, that my client who's probably got an MBA is going to go, you're talking my language. We communicate. They hire me for their next deal, and their deal after that, and their deal after that, and then they go tell all their friends to hire me. Now, one of the most classic areas, and this is one where I got to tell you, any lawyer who's not using this type of analysis in the litigation setting, I don't know if it's malpractice, but boy, it's really, really very sloppy thinking. How do you make a choice here? So here's your classic, your client's been sued. I've got 3 classic choices: defend the lawsuit, accept the plaintiff's offer, or make a counteroffer. What do? If you haven't valued out each of the options, what irresponsible advice you're giving your client. Horribly irresponsible. Okay? Now, one other one, and this is just near and dear to my heart, pricing decisions. And again, like this is one lawyer's like, we just throw the price out there. As lawyers, you've got to make pricing decisions. Law schools have to make pricing decisions. Do you charge a high price, a medium price, or a low price? There's a value proposition with each one of those. They would each give you a very different outcome. You should have a thorough understanding of each outcome, and then you can make the best decision. Okay? Now, real quick, and then I want to start getting into valuation. What is value? So you can sort of, I assume you understand. Well, there's a lot of decisions that need to be made. This is just, since we wrote a book on patent valuation, this is an area where we think a lot about some of the decisions. This is just a tiny fraction of the decisions that really could be aided by pretty simplistic valuation analysis. Do you get a patent? Do you not get a patent? Right? I could put a value on both choices. When I'm drafting patents, broad claims, narrow claims, that one's a little tougher actually to put a value on, but it's possible. This is one that I think's actually, and I didn't know how to word it properly, so I just left it up there, not worded exactly the way I want. Because it's really, the choice is not usually, do you pursue an international strategy or do you not pursue an international strategy? The real question is, I'm going to pursue some type of international strategy. What countries? I think there's 182 different countries you can get a patent in. Which countries do I choose? How do I do that? Right now, you know how lawyers do it? Rule of thumb. We tend to, for electronics, we use these 3 countries. For pharmaceuticals, we use these 150 countries. And it'll just be sort of like word of mouth passed down from the from a partner to the associate, and it just becomes that's what we do. My gosh, this is really an area. If you ever end up working in-house as an IP manager, this is definitely an area that is going to be one of the most significant parts of your budget. Other than your salary and the other workers in your department's salary, that's probably the single biggest number in your budget. You manage that number better, your department will be more successful. And then there's more room for your salary to grow. And here's just a few others: licensing versus practicing a patent, different licensing strategies, who to license to, all of that can be done with valuation. Now, just one thing, you're thinking, why, these sort of weird little structures as to how all these decisions are lined up here. What I'm trying to do is just sort of slowly to get you to thinking about, by the time we're done with this seminar, I really am hoping that you start thinking about decisions in this type of format, because one of the things that we're going to introduce you to is the idea of decision trees. Decision trees have been around for a long time. If you ever get an MBA, I think just about every MBA program in the country will have you doing decision trees at some point. It's a really powerful tool. It is a tool that has not been embraced at all by lawyers or the legal profession. But it's very powerful. And so if you look at like some of these, like really easy ones, like, obtain a patent, not obtain a patent. You know what we could do? We could come up with what are the factors that tend to drive the value of obtaining a patent. What are the factors that tend to drive the value when I don't obtain a patent? And every time now it's time for me to make that decision, plug in a couple of factors, decision tree spits out an answer. I can start automating a lot of this decision-making process, making me a lot more powerful, freeing me up to spend my time making decisions that are much more valuable as opposed to this decision, which is really kind of a commodity type decision. I shouldn't be spending a lot of time doing this. Right? And right now it's the worst. This is a commodity decision, and I usually don't feel good when I make it because I don't know whether I made the right decision or not. And I can be second guessed by my management. Whereas if I can start reducing this into a decision tree and I can get my management to be a part of that whole process, free myself up, I can make more decisions faster and better. All of these things can start to be brought down. The international one is a classic one. So one of the things, this is a project that Professor Murphy and Professor Firking and I are going to be working on, is trying to come up with some decision trees that will allow for some of these decisions to be made on a better, faster basis by lawyers going forward. And frankly, it's one of the nice things about being at a school like this. The nice thing about going to having students who, and I say this with love, are nerds, we can start using things like decision trees. You're like, yeah, sure, no problem, right? It's like, it's not a big deal at all. And hopefully, you guys can be the kernel that spreads this type of thinking throughout the legal profession. Because for the most part, lawyers resist this type of thinking. Okay, now, none of those decisions you can't make any of those decisions on a truly informed basis without doing valuation. Now, I'm almost done with my setup, and then we'll start talking about value. Some basic valuation misconceptions. First, valuation analysis can only be conducted by financial experts. That is flat out wrong. Now, financial experts are really good at selling their service. They sound good when they talk about it, and in fact, one of the as a former seller at times of financial advice, so much of the game is to make yourself sound much more important and intimidate the person that you are providing the advice to so that they feel, I can only get that advice from you, because it's so complicated. By the time this seminar is over, you really should see, it's, financial, the type of valuation, it's really not very complicated. There's a lot of little parts. Each part's very simple. There's a lot of parts. If you take it piece by piece, by the time you're done, no problem at all. Output from the valuation analysis, the value result is more important than the valuation process. Again, as we go through this, one of the things you're going to see, you learn so much by doing a valuation analysis. One of the things we are going to do in our very next session, I'm going to show you how to build a basic discounted cash flow model. You have to bring in your computer. Make sure you've got Excel on your laptop, and I will show you in less than 5 minutes how to build the model. And then I will show you how to build projections. That'll take more than 5 minutes. But you'll start seeing the process. And for anybody who's ever worked within a company, and you start saying, wow, I was in the company, and you know what? Nobody had all this information you're talking about. And I will show you techniques as to how you can pull all this various information from various parts of your client or company. And you go, well, nobody ever did that within my company. You can be the person who really brings more knowledge to your organization. The more quantitative and mathematical approach, the more accurate the value result. As Murphy can tell you, I really can barely do math, right? My math skills, I will say, in all honesty, I think my math skills right now are probably those of a 6th grader. I can do multiplication and division when I have a calculator. I can do it on paper. Can't do it very well in my head. You don't need to be very mathematically inclined. Now, what you do need, you need to be comfortable with numbers. And not, if you've got a number phobia, every once in a while you'll run, and it's just like, oh, I start seeing numbers and I can't see anything. As we get into the seminar, I'm going to constantly be flashing numbers at you. I want to desensitize anybody who is sort of number phobic. But you don't need to be good in math to be very good in valuation. The math involved is incredibly simple. Valuation analysis must generate a precise result to be beneficial. That is inaccurate because one of the things you will find, the valuation analysis that we do almost never generates a precise result. That's not the way this process works. Let me give you a quick analogy to something that you should appreciate to help you understand this. Remember your first semester of law school. My first semester of law school, the course that tortured me the most and made me question why am I in law school was torts. The reason torts tortured me, I never got a straight answer. I found it to be very frustrating, right? So, I'd read the case and I'd go, aha, that person is going to be found liable for tortious behavior. You get to the end, no, oh gosh, no, this person not liable. Then you get to the next one, okay, this person's not liable. Oh, now we find them liable. And I was confused. And in particular, what was most confusing, the reasonable person standard. It was like I never agreed with the professor as to what was the reasonable person standard. Now, when you're in it, when you start thinking about torts, at least when I thought about torts, it was always like, it's all mumbo jumbo. There is no right answer. It's all mumbo jumbo. And I think even now, like if we were to talk about torts and we go reasonable person standard, what does it mean? We probably joke around amongst each other. It means anything. Now, what if an outsider comes in, a non-lawyer, so somebody who's not been in our world comes in, so your mom comes in and goes, oh, torts, reasonable person standard, it can mean anything. You go, no, that's not true, right? Because the reality is, well, there's boundaries. So we could come up with these, well, no, that could not have been a reasonable person to have done that. That's outside the boundaries, right? Within the boundaries, it can mean anything. But there are boundaries where useless. That's what happens when you're generating a valuation analysis. The value result is very much like the reasonable person standard in tort law. There are boundaries, and those boundaries can be very wide. And within that, it's like it can mean anything in there. But then there's, things outside that. So, if I'm talking to another valuation person, and I go, well, what's the value? To me, it's the process. The result, oftentimes, who cares about the result? Why? Because the result can mean anything. If I'm talking to a valuation person, if I'm talking to an outsider, I'm much more careful. There are boundaries, okay? All right, and then finally, there's always this desire, I think there's a belief, for people who haven't done any evaluation analysis, there's a belief there's a magic mathematical formula out there, sort of like the sorcerer's stone, that if I get that, with that, I will now be able to value everything with precision. There is nothing. There's nothing like that. Okay. Now, most people would agree, okay, this is great. So you just showed me, you spent too long talking about it. Decisions would be improved with valuation. Great. But it's too much of a pain, right? So you're telling me every decision I make, right? Should I wash my hands right now? Right? Should I wash my hands before I have lunch? Well, let's go do a little Excel spreadsheet here. We could talk about the risk of me catching the flu because I didn't wash my hands. You don't make those. You make decisions very quickly all the time. It's silly. I only do valuation when I really need to because it's very complicated. Now, make sure where I am on my slide. What was I doing? Okay, here we go. So, first criticism. Valuation analysis is complicated, expensive, and requires valuation experts to do it properly. Not true. And as we go through, you're going to see how easy it is to do valuation. And frankly, what I'd say, Murphy and my goal, what we'd really love, we want to infect the legal profession with lawyers who think with a valuation bent. And you'll see how easy it is to bring it into your organization. It's not challenging at all. And you don't need to be a super expert to do it. Now, one of the things when it comes to valuation that's important to appreciate, you really don't need to come up with exact numbers. You're making so many decisions that you can actually do really very much back of the envelope analysis, and that itself can be extremely powerful. Now, there's a very dense text here, but let me just sort of explain the concept. Economists would divide your basic decision-making strategies into three categories. And actually, the guy who sort of came up with the third category is a guy named Herbert Simon, and he actually won the Nobel Prize in economics for the insight I'm going to share with you. And it always makes me think, I wish I had become an economist. The ones who become the most famous professors always come up with the most obvious insights. If there's one thing I am Captain Obvious. So I always thought that's really where I should have been. Now, first one, maximizing strategy. The idea here is, before you make a decision, you collect all the information possible, regardless of price, before you make your decision. So you conduct an extremely exhaustive valuation analysis before making the decision. Collect tons of information, analyze it, then make your decision. Now, problem with the maximizing strategy? It treats information gathering and analysis as if it's free. It's not free. It's very expensive. So in any organization, you have to sort of cut back at times. And so then the strategy that sort of came out as, well, this is the strategy that you should do, is the optimizing strategy. Where basically what you do is you collect information so long as it provides you with a favorable cost-benefit outcome. So as long as obtaining more information will generate more knowledge than it costs to get, keep looking for more information. So this is incredibly exhaustive effort. This is very thorough effort, but not as exhaustive. Now, this optimizing strategy in many ways is kind of a dangerous one because it sounds good. Well, sure, collect information as long as the benefit of collecting the information exceeds the cost. Keep doing it. The problem is it's very difficult to do that kind of cost-benefit analysis, and what it tends to lead to is too much analysis before you make decisions. Before, I was criticizing people doing no analysis before making the decisions. Doing too much analysis before you make decisions, in particular in an organization, can be just as problematic. Now you're not capable of making decisions, you're not flexible, you become bureaucratic. This is not a better outcome. Well, what Herbert Simon came up with was the idea of pursuing a satisficing strategy. And the idea here is you're going to collect enough information to make a good enough decision. Set your bar low. I'm just going to do what's good enough. And as soon as I've got that information, I stop. Yeah, but there's a little more information out there. I stop. Good enough because I've got to make so many decisions. Organizations that basically sort of put blinders on and say, I am going to collect this much information so that I am making a more informed decision and then stop, will do better. a huge part of what we're going to be looking at what I'd like to do in this seminar, we're going to start with doing sort of really full foundational analysis. Once you know how to do the hard stuff, then I'm going to show you how to do the easy stuff. And we're going to look at a bunch of different satisficing strategies that will allow you to do your decision making much quicker. But it's okay. I always think it's best to learn that last. You know how to do the real stuff. Now I'm going to show you all the shortcuts. Okay? Very powerful, though. Now, appreciating this range is a very important concept. This is just sort of, and actually even this doesn't really reflect the proportion of decisions that are likely to be satisficing decisions. Your maximizing decisions should just be like, this should be like a hair's width. There are so few decisions you would ever do that would qualify as a maximizing decision. Tiny, tiny fraction. A little bit more would be optimizing decisions. So for example, I want to sell my company. That's probably an optimizing decision, right? I'm doing some sewer settle analysis for the $500 million lawsuit my company faces. I'm going to be doing at a minimum an optimizing decision there, right? I should be doing a very thorough analysis. I'm deciding whether to get a patent or not. Satisficing decision. The vast majority of your decisions are going to be satisficing. Okay, now, let me see what time it is. All right. All right, now. Let's get into the concept then of what is value. This is it. This slide, you need to burn this into your memory. I can't tell you how many people I've talked to, in particular people who get done with an MBA and they learn a bunch of valuation stuff and they forget the real basics. Never forget your basics. What is value? The net benefits that come from an asset or service. Now, in finance speak, if you're a company and I have an asset, how do I think about my benefits? Cash flows. One of the other things we're going to do during this seminar, later on we will spend, and I'm going to guess it's probably going to take 2 sessions, because I am going to guess most of you have 0 to minimal accounting background. Anybody know basic accounting? How many people have got a little bit? Actually, you guys are pretty, that's pretty good. That is more than I would normally get in a typical lawyer audience. But we're going to spend a little time on accounting so that when we talk, cash flows is a specific term. It means something. It's not a generic term. Now, for our purposes right now, cash flows are a better number than profits. That's really what you need. These are profits that I've actually collected. Good stuff there. Okay? Now, so this is our basic. What we're really looking at, every valuation analysis is trying to identify the net benefits that come from that asset or service. And as we get into it, we'll stop talking, so at the beginning we're going to talk a little bit about benefits, and benefits can be a lot of different things. Because for the most part, when you're going to be using these techniques are almost always going to be in the business setting. So as we move through the seminar, we will go back more and more to cash flows as being the net benefit we're trying to calculate. Okay? Now, one more concept from here. When you get net benefits, the net benefits you receive almost always, or not even the vast majority, like 99.999% of the benefits you receive in most transactions are going to be future benefits. So if I was really saying this, if I was talking to a bunch of finance people, it's going to be the future cash flows that come from an asset or service discounted back to present value. And we will look at that as well. We'll see how to do that. Very simple stuff. Now, fundamentally then, what does valuation involve? Valuation involves 2 things. Identify the benefits, measure them. That's it. That's all you're doing in any valuation exercise. When we talked about the value of going to law school before, what was I trying to get you to do? Identify the benefits of going to law school, and then from there we would have to start ascribing values, we would have to measure each one of those benefits. That's what the rest of this seminar is all about, identifying benefits and measuring them. Now, I really want this to be concrete, so I'm going to give you about as easy an example as possible. You are making a decision whether to buy an apple. Why do you want to buy the apple? Well, you are probably hungry and you like apples. What are the benefits you get from buying an apple? It's healthy. It tastes good. What price should I pay? I should be willing to pay any price less than the value of the sustenance it provides to my body, and I'm going to call that SV, coupled with the value of the enjoyment you get from eating the apple, and I'm calling that EV. I can add up both of my values. So now, as we move along, we'll start looking at, well, instead of me just going to assume this value, we'll figure out, well, how would we start to calculate this kind of value? Although when it comes to an apple, this is probably a very good time for you to do some nice satisficing analysis. You're not going to get out a spreadsheet and start looking up, so what is the health benefits of an apple? It will help increase my life by X%. I value that at, we don't need to do that. But in this case, so the sustenance value, $1, the enjoyment value, 50 cents. In this case, you should be willing to pay any price up to $1.50 for the apple.
But I think the hard part is putting a monetary value to certain things you value. Like, for example, how would you know your sustenance value might be $1, but mine might be $1.50?
I am so glad you made that point. Now, the first thing is, it's true, and with the Apple one, coming up with these dollar amounts, it's kind of challenging. Although I can tell you, if we thought about it, we could come up, we could use some techniques to try to figure out this value. There are actually a lot of things we could do to come up with it. So just real quick, like for example, enjoyment value. We could actually start doing a test as to, what would you rather have? Would you rather have this? Would you rather have that? We could come up with ways to tease out that 50 cents. Now, remember, it's not going to be perfectly 50 cents. Maybe it's 48 cents. Maybe it's 72 cents. Maybe on Monday, it's 61 cents. But on Tuesday, it's 49 cents, right? It's not, it can fluctuate. We could come up with ways to do that. But the real important point you made, your value and my value may be very different. And I think this is one of the things, this is very important. When we look at our different valuation techniques, one of the valuation techniques we will look at is the one that usually gets talked about first. I always talk about it second, because I don't believe it's the one. In order to truly understand valuation, I think you need to start by what I'm doing here, which is really a form of income method where I am trying for you, for me, to come up with our own personal value. The valuation technique that people use most often is a market value, where I'm not trying to calculate what the value is to me. I'm trying to calculate what the value is to everyone else. And I'm going to assume, well, if that's the value for everyone else, it should be good enough for me. So, but it raises the issue. Valuation is a relative process. Your value and my value may be very different. The value of the apple in your hands and in my hands may be very different. So let's say, for example, I have got scurvy. I'm not very healthy. I live on Skittles and hot chocolate, right? I've got scurvy. You look like a healthy individual. You don't have scurvy. The sustenance value of that apple to me might actually be a couple $100. Right? Because if I actually eat that apple, maybe now I don't have to take so much of my scurvy medicine. And as a result, that apple to me is worth $300 because that's how much my next scurvy prescription is going to cost me. You're healthy. The sustenance value for you, you eat the apple, you don't eat the apple. Maybe the sustenance value for you, like 1 penny. That sort of thing can happen. Okay? All right. Now, but the important thing is, what did we do? We identified the benefits of owning an Apple, and we measured the benefits. That's all you ever do. Can you do the same thing for anything else? Of course. Now, let's use this as another simple example. This is really, in some ways, it's a simple example to understand, but then coming up with the numbers, whoo. My securities rate class, we're going to try to do this later on in the semester. Well, we'll do a little bit to try to come up with the numbers. So you're thinking about buying common stock. Now, this is one that's really near and dear to my heart. I go and talk to professional investors. What's common stock? They don't know. Blah, blah, blah. It's a security. It's blah, blah. A lot of words. It's kind of like when we look at, what's consideration, and lawyers will go blah, blah, blah. Well, what's consideration? Tell it to me in one sentence. Can't do that, right? Common stock. What is common stock? Why do you buy it? Any day traders? No reckless day traders in the group? I don't believe you. There's always a degenerate gambler somewhere in the group that's like, well, yeah, I day trade. Okay, so what are the economic benefits that come from buying common stock? Right? Why do those prices go up and down? What are you doing when you're buying common stock? The most significant thing you are buying when you purchase common stock is a pro rata right to the residual. Has everybody taken business associations in this group? Anybody not taken business associations? There's a couple of you. Now, so what's residual? Basic idea, right? We all understand corporations exist. Shareholders own corporations. Why do you own a corporation? Well, you want to make money. How do you make money by owning a corporation? Well, the corporation owns assets, and the corporation is responsible for its own liabilities. So the first thing, as the shareholder, I don't own the assets. I'm not responsible for the liabilities. The corporation is. It is its own legal entity. Now, what I do own is what's referred to as the residual. Hopefully, my corporation, if I own a good corporation, it is accumulating more and more assets. And in particular, it's accumulating those assets at a rate that is higher than it's accumulating liabilities, so that I am getting more assets to liabilities constantly, right? I want it to constantly be getting a bigger gap between the amount of my assets and the amount of my liabilities, because that's effectively what I have a right to, is this excess. Assets minus liabilities is the residual. And as a shareholder, I have a pro rata interest in that residual. I get paid out of that residual in two ways. Actually, there's more than two ways, but two fundamental ways. The corporation can issue a dividend. That dividend is them saying, here, I'm going to give you some of your residual. That's great. The other way, at liquidation. So when the corporation either shuts down, which that only happens really with private companies, or when the company gets bought. If you get bought for cash, you've effectively liquidated the company, at which point all the cash flows into the corporation, all the liabilities are paid off, the assets go to the acquirer, and that excess, the residual, is left to be paid out to the shareholders. Okay? So fundamentally what I'm buying is a pro rata stake in this residual. Now, what have I done? Well, I've identified the benefits of owning common stock. What is the main benefit? The main benefit is a pro rata stake in the residual. Now, can I determine the value from those benefits? So in this case, I have my right to the share in the residual. That is fundamentally what I'm buying. Now, blah, 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 blah. So the value. How do we value the future residual payout? This is, you asked before, how do we come up with these numbers? Now, real quick, when I'm buying that residual, when am I supposed to get paid that residual? Is it today? So like if right now I go and I'm going to buy 10 shares of Google, do I then get to go and knock on the Google CEO's door and say, give me my share of the residual. You can have your stock back. I want my residual. No. Right? When do I get paid the residual? And Google doesn't pay a dividend. I don't think they pay a dividend. So I'm going to get paid when Google liquidates. When do you expect Google's going to liquidate?
Never.
Right? Maybe never, right? It's a long time. So it's sometime in the future. Now, the point I want to make here is that in this case, oh, that's supposed to be funny, right? Where do residuals come from? Not the stork. Okay, residuals come from profits, right? How do I get more assets over liabilities? I generate profits. By definition, what is a profit? It is, I spent some money, my expenses, and I generated revenues. The revenues exceed the expenses, they give me profits. Profits give me cash. Cash is an asset. Right now, my bank account goes up, and it should be going up faster than my liabilities because that's what the profits are, right? So profits are what create my residual. When I'm buying common stock, I should be doing two analyses. First, what is the company's current residual? This is something that we will look at. Actually, we may look at it in a later seminar. We'll definitely be doing it in my securities reg class. And we're going to be looking at a company's balance sheet. And if you don't know what a balance sheet is, this is why you need to understand basic accounting. I can go to a company's balance sheet and I can get a back-of-the-envelope calculation. It's not a very accurate calculation, but it's it's kind of a quick and dirty calculation of the company's current residual. If you go take a look at anybody who's like, I kind of know what a balance sheet is, it's typically going to be labeled stockholders' equity. That is the amount of excess of the assets minus the liabilities. Now, most of my residual, though, isn't currently there. The idea is I'm buying a company that's very profitable, that's going to be making money off into the future. So I'm primarily buying the future residual. So the value of my stock is fundamentally driven by forecasts of the corporation's future profits that are going to drive its future residual. So in order for me to figure out the value of common stock, I need to be able to build models that forecast that company's future profits. So for any of you who are closet day traders and you just didn't want to admit it, you'll see like when if you watch like any of the financial analyst shows, they'll usually talk about like next year's profits. Maybe every once in a while they'll talk about profits 2 years out, or they'll talk about things like PE ratios and all that. What they are doing is using very crude tools to try to forecast the company's future residual. Think about it for like Google. Think how far in the future you have to forecast those profits. When we build our DCF model, we will do some forecasting, and we'll see about this whole concept of forecasting and how we build models to try to accomplish that type of information. Are we at 1 o'clock now? Oh, 1 o'clock. Now, do people need to leave now, or? Yeah. All right, so why don't I just wrap up here, and then we'll pick up next. So is there a preference for every other Tuesday or every Tuesday? Every other? All right, every other. So in 2 Tuesdays we'll pick up. I'm going to do a quick walkthrough in those, just sort of I'm going to here, and I'll send out the slides as well, so anybody who wants them. I'm going to show you the 3 basic methods, and then what I really want to do on the next Tuesday, I'm going to show you how to build a discounted cash flow model. So today was a little talky. I promise it won't be so talky in the future. It'll be more dewy. All right? That's it.